Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for Chapter 18 of our intermediate accounting textbook. And so Chapter 18, we're revisiting revenue recognition. We have talked about revenue recognition principles before. We talked about that way back in Principles of Accounting 1 and 2, and we got practice with revenue transactions. Obviously, we've gotten a lot of practice with revenue transactions. And so now in this chapter, it's introducing us to some new concepts with revenue recognition, kind of a five-step process that's covered. And then when there are, multiple performance obligations on one contract, for example, and allocating that. And then some of the different issues that we deal with that we have heard of before, some of them will be new to us. Sales returns and allowances, repurchase agreements, bill and hold arrangements, principal agent relationships, things like that. So some new things with revenue recognition, and then some other things again that we've talked about before and that will look familiar to you. So I'm going to share my screen with you and get these PowerPoints pulled up. And let's see here, share screen, PowerPoints. Okay, so our Chapter 18 PowerPoints, and again, I'll get these posted into OwlNet as soon as I'm finished with this recorded lecture. The main learning objectives of Chapter 18, and let me start this from the beginning here. The main learning objectives for Chapter 18, understand the fundamental concepts related to revenue recognition and measurement, understand and apply the five-step revenue recognition process. Number 3, apply the five-step process to major revenue recognition issues. And then 4, describe the presentation and disclosure regarding revenue. And so, revenue recognition, again, we've talked about the revenue recognition principle before. Basically, just overall revenue recognition principle states that we have to record revenues when they're earned rather than when the money is received, right? This is why we have like the accounts receivables accounts or the trade receivable accounts, right? We have to record revenue when it's earned rather than when the cash is received. So we've got plenty of practice with that before. And just like it tells us in our book, essentially FASB and then the International Accounting Standards Board came together to develop, I guess, you could call it the new revenue recognition standard. This is discussed on page 980 of your textbook. And basically, they gave further guidance on revenue from contracts with customers. And so as we're going to see as we go through this, we're approaching this from an asset liability approach. So we account for revenue based on the asset or liability arising from contracts with customers. An asset, an asset would arise from a contract, obviously, if we're selling goods or selling services, and then the customer owes us money, then an accounts receivable arises type thing, right? Or a liability arises, again, when the customers pay us in advance and then we owe them something, right? So an asset or a liability can arise from the contract with customers. And so we're required to analyze contracts with customers, looking for some of the specific, specific, I guess, provisions or rules to help us determine whether or not it's a valid contract. So contracts indicate the terms and measurements of consideration. So, for example, how much goods or how many products are being sold for how much money type thing. And then contracts are important, just like it shows here. Companies cannot know whether promises will be met without contracts. So the new revenue recognition standard is illustrated. Again, this is page 981 of your textbook, illustration 18-1. So some of those key concepts of revenue recognition, the key objective is to recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for these goods and services, right? And so this 5-step process, and we're going to walk through and look at examples of each step here in the process, but the 5-step process: number 1, identify the contract with customers. Number 2, identify the separate performance obligations in the contract. And, you know, if we're only selling, for example, one product, then obviously there's one performance obligation, right? But if we've got multiple products or multiple performance obligations within a contract, we have to determine kind of how to allocate the price, the transaction price, to each of those performance obligations. Number 3, determine the transaction price. Number 4, allocate the transaction price to the separate performance obligations. As we're going to talk about too, when there are separate performance obligations, these performance obligations can be, you know, basically intertwined, or one is dependent on the other type thing, or they can be what your book calls, and I'm just looking for the page where it says this to us, distinct, which means they can be sold separately and are not interdependent, right? And then number 5, recognize revenue when each performance obligation is satisfied. And again, revenue, that revenue recognition principle, we recognize revenue in the accounting period in which the performance obligation is satisfied. Okay, so the 5-step process, again, using Boeing as an example, it's going to walk us through these 5 steps. And then as we continue through the PowerPoint, we'll see more examples of these as well. So this example out of your book, it says, assume that Boeing Corporation signs a contract to sell airplanes to Delta Airlines for $100 million. So again, step 1, identify the contract with customers. Again, the contract is the agreement between Boeing and Delta to produce and deliver $100 million worth of planes, right? So that's the contract between Boeing and Delta. Step 2, identify the separate performance obligations in the contract. So in this particular contract, because it doesn't specify like if it's different airplanes or the same airplanes or whatever, Boeing only has one performance obligation, which is to deliver the airplanes to Delta, right? So just like it shows here, if Boeing also agreed to maintain the planes, that would be then a separate performance obligation, because maintaining is separate and distinct from producing type thing, right? So there'd be a separate performance obligation recorded in that case. All right, step 3 and step 4. Again, step 3, determine the transaction price. The transaction price was written into the contract. So the amount of consideration that Boeing will receive from Delta is straightforward, just like it shows here. It's $100 million, right? Allocate the transaction price to the separate performance obligations. Again, in this case, there's only one performance obligation. But when there are multiple performance obligations, as we will see as we continue through the PowerPoint slides, and then of course, as we get practice with this in class together, when there are multiple performance obligations, generally what we do is we allocate the cost based on proportion of the total. So kind of similar to what we have done with various transactions in the past, you know, looking at what each one takes up of the whole, basically is what we'd be looking at. Step 5, recognize revenue when each performance obligation is satisfied. So Boeing would recognize the revenue of $100 million for the sale of the airplanes to Delta when it satisfies the performance obligation by delivering the airplanes to Delta. So again, you know, if we think about, okay, when Boeing and Delta made this agreement, at that time, Boeing would not have recognized any revenue. They wouldn't recognize revenue until the planes are actually delivered to Delta, because at that point, then Delta has control of the asset, right? Which is an important part of the performance obligation being satisfied, right? All right, so step one, again, as I said, it briefly went over each step within the Boeing example, and now it gives us another example going through each step a little bit more in depth. So again, step one, identifying contract with customers. So the contract is the agreement between two or more parties that creates enforceable rights or obligations. Contracts can be written, oral, or implied based on customary business practice. The company applies the revenue guidance to a contract according to the following criteria. So number one, the contract has commercial substance, which means something of monetary value is being exchanged. The parties have approved the contract, both have accepted. Step three, identification of the rights of the parties is established. So again, what is Boeing entitled to once the planes are completed? What is Delta entitled to once the planes are completed, right? The rights of the parties. Number four, payment terms are identified. And then number five, it is probable that the consideration will be collected. So when these criteria exist, right, then that is a valid contract. All right, so here's an example of this. It says on March 1, 2017, Margo Company enters into a contract to transfer a product to Soon Yoon on July 31st, 2017. The contract is structured such that Soon Yoon is required to pay the full contract price of $5,000 on August 31st, 2017. So we're going to deliver the product to them on July 31st, and then they get a month to pay, basically. They're going to pay us by August 31st. The cost of goods transferred is $3,000. Margo delivers the product to Soon Yoon on July 31st. So again, what journal entries should be made in regards to this contract? So the entries related to the sale, to record the sale, the related cost of goods sold, and the payment are as follows. Again, we've seen all of these before. So to record the sale, debit AR, credit revenue. To record cost of goods sold, debit cost of goods sold, credit inventory. And then of course to record the payment, debit cash, credit accounts receivable. So essentially on this, our gross profit is 2,000, right? Because remember, we always take sales minus cost of goods sold gives us gross profit, right? So essentially gross profit, 5,000 minus 3,000, gross profit then is 2,000 on this example, right? All right, the separate performance obligations, step two. So a performance obligation is a promise to provide a distinct product or service for a customer. A product or service is distinct when the customer is able to benefit from the good or service on its own without depending on another part of performance or another part of an obligation. And then also the performance obligations are distinct when together with other readily available resources. So just like it shows here, contracts either have one performance obligation or multiple obligations, right? Multiple obligations are extinct or distinct, rather. I said extinct. I'm thinking about dinosaurs. Multiple obligations are distinct when they can be sold separately and are not interdependent on each other. And so, your book gave us the example, looking at Boeing. If we had, an agreement with Delta, for example, Delta's going to purchase, 10 747s or whatever, but then we got a separate performance obligation that over the course of 10 years, for example, Boeing's going to maintain those planes for Delta. So a maintenance program or service program, right? And so those would be two separate performance obligations, right? Because technically we could sell planes by themselves. we could also sell kind of the service contract but by itself as well. They're not interdependent. All right, step 3, determine the transaction price. So again, the transaction price is the amount of consideration that a company expects to receive from a customer. In a contract, it is often easily determined because customer agrees to pay fixed amount. In some contracts, though, there are some variations, if you will, or other considerations. For example, variable consideration, the time value of money, non-cash consideration, and then consideration paid or payable to the customer. So we're going to look, we've got a slide for each one of these. And so we're going to look at these, but basically variable consideration is when, you know, for example, we might get price decreases, volume discounts, rebates, credits, bonuses, royalties, things like that would be things that they're variable consideration because they're not set in stone necessarily. It varies based on some different factors. And so we're going to look at that. And then time value of money considerations, you know, time value of money, we've gotten a lot of practice with this before. And basically, we know that notes receivables, notes payables and stuff, we have to put on our books. We have to value on our books at present value, right? So that's where we're looking at like present value of annuity or present value of one calculations. Non-cash consideration. So it says companies sometimes receive consideration in the form of goods, services, or other non-cash consideration. You could think about this like bartering or trading, you know, bartering being that, you know, but basically, for example, you know, my husband does floors. You guys, I've talked about that a lot before. And so if he needed, you know, mechanic work done, and his mechanic needed flooring work done, right? Instead of paying cash to each other, they could barter their services, right? So that's one type of non-cash consideration. And then consideration paid or payable to the customer. This includes, again, discounts, volume rebates, coupons, free products or free services. And we kind of got practice with these when we looked at current liabilities, you know, where, you know, maybe if someone mails in 10 box tops, they get a free mixing bowl or something like that, right? That would be an example of consideration paid or payable to the customer. All right, variable consideration. Again, we only allocate variable consideration if it is reasonably assured that that the company will be entitled to the amount. Companies only recognize variable consideration if, number one, they have experience with similar contracts and are able to estimate the cumulative amount of revenue. And number two, based on experience, they do not expect a significant reversal of revenue that was previously recognized. So, and as it shows here, if these criteria are not met, revenue is constrained. And by revenue being constrained, you know, essentially, and I'm trying to find this, it says it like halfway down page 989, that when revenue is constrained, let's see here, I'm trying to find where it's at, darn it. Well, I don't know. I don't want to waste too much time trying to find exactly what it said. It was between page 989 and 990, if you wanted to look into that a little bit more. Time value of money. Again, this is where we're looking at, you know, essentially present value when we value like notes receivables or notes payables, things like that. We're looking at the present value of future cash flows. And so that's what we're talking about here. When contract or sales transaction involves a significant financing component, So interest is accrued on the consideration to be paid over time. And again, this can be, this can be applied to either, accounts receivable, and maybe here, let me even be a little bit more specific. This could be applied to notes receivable or notes payable, right? And I mean, even if we think about like a company credit card, like a in-house charge account or whatever, that technically would be considered an accounts receivable, but that would accrue interest as well. So something to keep in mind there. Fair value determined either by measuring the consideration received or by discounting the payment using an imputed interest rate. Company reports as interest expense or interest revenue. So interest expense in the case of like a note payable, interest revenue in the case of like a notes receivable. All right, non-cash consideration. Again, we talked about non-cash consideration. I think the easiest way to kind of think about this is just bartering products or services. So companies sometimes receive contributions, donations, or gifts as non-cash consideration. Customers sometimes contribute goods or services, such as equipment or labor, as consideration for goods provided or services performed. Again, we call this bartering. Companies generally recognize revenue on the basis of the fair value of what is received. All right, and then consideration paid or payable to customers may include discounts, volume rebates, coupons, free products or services. In general, these elements reduce the consideration received and the revenue to be recognized. So, again, I use the example of, and I think we talked about this, I don't know, in chapter 13, I want to say, current liabilities, when we talked about like the warranty, the different warranties, and then also where, for example, if we send in, 10 box tops, we get a free mix and bowl or whatever. Or, we see this with, like rebates also, where, you buy the product, you got to mail in the rebate for it. So those are some things that we've touched on before, again, and that we'll touch on looking through and getting examples with some of these. All right, so step 4, allocating transaction price to separate performance obligations. So as we've seen before with these calculations, usually we're looking at a proportion or a percentage of the whole. So what each performance obligation takes up of the whole, basically. So based on their relative fair values or their proportions, right? Best measure of fair value is what the company could sell the good or service for on a standalone basis, or best estimate of what the good or service might sell for as a standalone unit. So a couple of these approaches that we can take: the adjusted market assessment approach, basically evaluate the market in which it sells goods or services and estimate the price that customers in that market are willing to pay for that, for those goods or services. That approach, or this approach, is adjusted market assessment approach. Might also include referring to prices from the company's competitors for similar goods or services and adjusting those prices as necessary to reflect the company's costs and margin. The expected cost plus a margin approach. So this is where we would forecast expected cost of satisfying a performance obligation and then add an appropriate margin for that good or service. Again, if we want, to make 10% profit off it, then we would add that 10% margin type deal, right? So something to that effect. And then the residual approach, we've gotten practice with this before, but previously in these types of calculations, we called it the incremental approach, which I probably don't spell that right, but that's fine. Incremental approach is where, if we've got separate performance obligations, we know which one of them is worth. And then so whatever the residual left over is what is allocated to the other one type thing. So the residual approach, it says if the standalone selling price of a good or service is highly variable or uncertain, then a company may estimate the standalone selling price by reference to the total transaction price less the sum of the observable standalone selling prices of other goods or service promised in the contract. So again, let's say we've got, 3 performance obligations and we know exactly what the price is of 2 of them, then whatever's left over, that residual amount is what would be allocated to the third performance obligation type thing. And then we did the same thing when we practiced the incremental method with bonds. And then what else did we do this with? Lump sum purchases of assets, lump sum purchases of securities, right? We called it the incremental method, but basically the same thing. All right, so here's an example. It says, if there is more than one performance obligation, how should the payment of $2 million be allocated to various components? And so I don't have the whole problem here. This, when I initially first pulled up these PowerPoint slides, there was like 140 PowerPoint slides. So I had to kind of get them down as much as I could. But this just shows us an example. It says the total revenue of $2 million should be allocated to the 3 components based on their relative standalone selling prices. In this case, the standalone selling price of the equipment is $2 million. The installation fee is $20,000 and the training is $50,000. So if we added all 3 of those together, 2 million, 20,000, 50,000, we've got a total of 2,070,000, right? And then so we're going to look at, okay, what does each one take up of the whole? So 2 million divided by 2,070,000. And that gives us basically the percentage it takes up of the whole. And then we multiply that by the price we're trying to allocate. And so we're going to allocate $1,932,367 to the equipment. We're going to allocate $19,324 to installation. We're going to allocate $48,309 to training. And so basically the equipment, this would be sales revenue. That's what we would charge to sales revenue or record in sales revenue. Installation would be service revenue. Service revenue. And then the training, what we're going to see is this is unearned revenue, because until we actually provide the training, we have not earned that yet type thing. So we see that here. It says, handler makes the following entry on November 1 to record both the sales revenue and service revenue on the installation, as well as the unearned service revenue. So again, we see an example of what that would look like. And this 48,000, I can't remember what it said, how many months this is for or whatever, but basically this would be, we would use like the straight line method, straight line, to allocate over training period, right? Something like that, over training period. So if this was like a 12-month training contract or whatever, we would divide it by 12 and then we would record a little bit of that revenue every month within our adjusting entries. Okay, step 5, recognizing revenue when or as each performance obligation is satisfied. So the company satisfies its performance obligation when the customer obtains control of the good or service. Remember, I mentioned that earlier. That change in control of the good or service is really what one of the big factors of when the performance obligation is satisfied. So some of the indicators of change in control: the company has a right to payment for the asset. The company has transferred legal title to the asset. Company has transferred physical possession of asset. Customer has significant risks and rewards of ownership. Customer has accepted the asset. So recognizing revenue from a performance obligation over time. And actually, so we're going to look at some examples of this, but in the appendix of our book, which I'm going to try to maybe do like separate recorded lectures for, you know, the couple methods they talk about in the appendix, although we're not going to be required to do any of these methods, these you know, anything from the appendix on the exam. You know, it's good to know that there are different, so we've got like the percentage of completion method. So that's one method that they talk about in the appendix. And then it also talks about the completed contract method, which is, you know, are not too bad. I mean, both are ways of allocating the cost over the life or the time period of the performance obligation. So maybe recording some of the revenue as progress, you know, as we go through the contract and we're progressing type thing. So we measure progress toward completion. The method for measuring progress should depict transfer of control from one company to another. The objective of methods is to measure extent of progress in terms of cost, units, or value added. So, you know, when thinking about these, again, these 5 steps to determine, you know, when revenue should be recognized, when the performance obligation is satisfied. And we looked at these before. So just to give us a reminder, identify the contract with the customers, identify the separate performance obligations in the contract, determine the transaction price, allocate the transaction price to the separate performance obligations, recognize revenue when each performance obligation is satisfied. All right, so accounting for revenue recognition issues. Again, some of these we have seen, some of these we have gotten practice with before, some of these will be familiar to you. But again, just like always, we'll get practice with a lot of these in class together. And so sales returns and allowances, we've gotten practice with sales returns and allowances before. Basically with sales returns and allowances, when we have a return, we're generally debiting sales returns and allowances, crediting like accounts receivable if the customer owed us money. Repurchase agreements, these are, and I believe there's a slide that kind of walks through each one of these, but repurchase agreements are basically when companies enter into repurchase agreements, it allows them to transfer an asset to a customer, but have an obligation, and either an unconditional obligation or right to repurchase the asset at a later date. And so depending on the repurchase agreement, the transactions are usually looked at as financing or borrowing, as opposed to actually recording revenue for it. Bill and hold arrangements, and that repurchase agreement, it's talked about this more on page 999, page 1000, those repurchase agreements. Build and hold arrangements. These are contracts under which an entity bills a customer for a product, but the entity retains the physical possession of the product until the customer is ready for it to be transferred. So as we're going to see, these are recorded just like normal sales. Recorded like normal sales. Because even though the customer wants us to hold on to it, you know, we're still setting the product aside for them. It's still technically theirs, right? So these are recorded as normal sales. Principal agent relationship. The principal's performance obligation is to provide goods or perform services for a customer. And so The agent's performance obligation is to arrange for the principal to provide these goods or services to a customer. And so a good example of this is like a travel agency. If a travel agency is selling trips for, whatever travel company, the agent is like the travel agent. The principal is the company actually providing the tours, for example. Consignments, we're going to see with consignments. And again, I know we've talked about this a little bit before as it relates to inventory, because remember, with consignment, so the consignor is the manufacturer or the producer of the goods, and the consignee is who is basically selling the goods. So a good example of these consignment transactions are like, if you think about, your closest car dealership, maybe it's a Chevy dealership, right? So General Motors produces the car. General Motors is the consignor, and then the dealer that's selling the cars is the consignee. And so remember that with the consignment transactions, the goods remain in the consignor's inventory. They are not considered part of the consignee's inventory. So those transactions, differ a little bit based on that information. Warranties, again, we saw these. We looked at some examples of different warranty transactions. We know that there's the assurance type warranty. And remember, the assurance type warranty is the warranty that automatically comes with the product. Like if you go and buy, whatever, Apple iPhone, it has a 1-year warranty with it, right? That's the assurance type warranty. And then the service type warranty, the service type are the warranties that you got to pay extra for. So, again, you go buy, for example, a new computer at Best Buy, and the computer comes with a 1-year warranty. That's the assurance type warranty. But then when you get up to the register, they say, would you like to purchase an additional 2-year warranty at such and such price? That's the service type warranty, right? And so depending on whether it's assurance or whether it's a service type, these transactions look a little bit different. We've gotten some practice with them before, but again, we'll get some more practice in this chapter together. And then non-refundable upfront fees. This can usually be, for example, the initiation, activation, or setup of a good or service to be provided or performed in the future. And so, the example they give us of this one in the book is like if you buy a gym membership and they say, okay, you pay $200 up front and then it's $25 a month or whatever. That $200 up front is like the non-refundable upfront fee type deal, right? So not too bad, I think, but again, we'll get practice with these different things in class together. All right, so sales returns and allowances, again, right of return is granted for product for various reasons. For example, dissatisfaction with the product. Company returning the product receives any combination of the following. So either a full or partial refund of any of the consideration paid, a credit that can be applied against amounts owed or that will be owed to the seller. This is like what we've talked about before, like a credit memo, or they can exchange it for another product, right? Repurchase agreements, again, allows the company to transfer an asset to a customer, but then they have an unconditional forward obligation or an unconditional right, a call option to repurchase the asset at a later date. And so just like it's shown here, if the obligation or right to repurchase is for an amount greater than or equal to the selling price, then the transaction is considered a financing transaction and therefore recorded as a liability, as we'll see when we get to looking at some of these in class together. Bill and hold arrangements, contract under which an entity bills a customer for a product, but the entity retains physical possession of the product until a point in time in the future. results when a buyer is not yet ready to take delivery, but does take title and accepts billing, recorded like a normal sale. Again, the example I think they give us this one in the book is that, we have, a coffee shop or a coffee franchise that is purchasing fireplaces for their six new stores, right? So they're purchasing fireplaces for their six new stores, but their six new stores aren't completely ready yet, right? They're not to that point in the construction process where they need those fireplaces yet. So whoever they bought the fireplaces from agrees, yeah, we'll hold on to them till you're ready. But again, the buyer is still gonna pay on them. It's still gonna be recorded like a normal sale. Principal agent relationships. Again, the agent's performance obligation is to arrange for the principal to provide goods or services to a customer. So they give us the example of a travel company, an agent that facilitates booking of a cruise for a cruise company, the principal. Priceline is an agent that facilitates sales of various services, such as car rentals at Hertz, who would be considered the principal. It says amounts collected on behalf of the principal are not revenue of the agent. Revenue for the agent is the amount of commissions received off of each sale. Consignments, again, we've talked about these before. We're talking about these a little more in this chapter. Manufacturers or wholesalers deliver goods but retain title to the goods until they are sold. So again, these types of goods are considered in the consignor's inventory, right? Even though the consignee is the one selling the goods, they're not part of the consignee's inventory. And that's where we've kind of ran into some issues with this before. So the consignor is the manufacturer or wholesaler, ships the merchandise to the consignee, the dealer, who is to act as an agent for the consignor in selling the merchandise. Consignor makes a profit on the sale, carries the merchandise as inventory. The consignee makes a commission on the sale. All right, warranties. Again, we talked about these before in chapter 13, I believe. The two types of warranties are the assurance type warranty or the service type warranty. As we mentioned, the assurance type warranty is the warranty that's included in the sales price that comes with the product, usually like a 1 year or 2 year limited warranty type deal. And then the service type warranty is the one that customers have to pay extra for. So, I use the example when you go to Best Buy to buy a computer, the computer is going to come with, for example, a 1 year warranty from Dell. But then when you get up to the cash register, they're going to say, do you want to buy an extra 2 year warranty for X amount of dollars, right? That's the service type warranty. And a service type warranty, as we've seen with these transactions before, as we'll get more practice with, is a separate performance obligation. And we usually record that in, and again, we've seen this before. We record those service type warranties as unearned warranty revenue until that time period has passed. If it's a 2 year warranty, right, it's recorded as unearned warranty revenue, and we allocate it or divide it up over the time period which it covers. All right, non-refundable upfront fees. Again, we talked about these a little bit already. So payments from customers before the delivery of a product or before the performance of a service. Generally, they relate to the initiation, activation, or setup of a good or service to be provided or performed in the future. And then just like it shows here, in many cases, these upfront payments are non-refundable. So membership fees in a health club or activation fees for a phone, internet, or cable service, for example. Okay, and then finally, learning objective 4 talks about the presentation and disclosure of some of these different issues. So Contract assets, as we're going to see when we get some practice with these in class together. Contract assets are basically when we have, for example, we had a contract with a customer and it had two performance obligations on it, right? But we're not delivering the whole contract. We're not delivering on the whole contract until both performance obligations are satisfied. So maybe, we've got this contract, we've got two performance obligations. We're not going to deliver on the contract until both performance obligations are satisfied. But if we finish one performance obligation first, then that is considered a contract asset until the entire contract is ready, until both performance obligations are ready. So, the book gives us an example, like if we have on our contract, for example, we have product A and then product B, and we're not going to deliver, we're not satisfying the entire performance obligation. We're not going to deliver on the contract until both A and B are completed, right? And so if we're working on performance obligation A first, and maybe we complete A and then we start on performance obligation B, that performance obligation A that is completed would be considered a contract asset until we complete the contract, at which time that moves from contract asset to earned revenue type deal is what we're going to be looking at with these. So contract assets are one of two types. We either have unconditional rights to receive consideration because the company has satisfied its performance obligation, or conditional rights, which is the example I just talked about. Both performance obligation A and B have to be satisfied to deliver on the contract. That's a conditional right. So conditional right to receive consideration because company has satisfied one performance obligation, but must still satisfy another performance obligation before it can bill the customer. We also have what's called contract liabilities. And again, for the most part, with these contract liabilities, we're going to be talking about unearned sales revenue or unearned service revenue. So again, contract liabilities, a company's obligation to transfer goods or services to a customer from which consideration has already been received. So when a customer pays us in advance and we owe them some type of product or service. So obviously we know where assets go on the balance sheet. We know where liabilities go on the balance sheet. So contract modification. So a change in contract terms while the contract is ongoing. Companies must determine, number one, whether a new contract and performance obligation results, or two, whether it is a modification of the existing contract. So the separate performance obligation, we account for this as a new contract if the goods or services are distinct and the company has the right to receive an amount of consideration that reflects the standalone selling price of the promised goods or services, or a prospective modification, or a modification made in the future, basically prospective, right? Companies should account for the effect of the change in the period of change as well as the future periods if that change affects both and not change previously reported results. All right, presentation. So a couple other things that we have to consider: cost to fulfill a contract. Companies divide fulfillment cost or contract acquisition cost into two categories: those that give rise to an asset and those that are expensed as incurred. And so it kind of talks about some of these in our book, and I'm just trying to turn to the page. So this is page 1010. So basically some of these examples they give us in the book, like those that give rise to an asset, direct labor, direct materials, allocation of costs that relate directly to the contract, contract management, supervision, insurance, depreciation of tools and equipment, And some of these, of course, are expensed as incurred. And also it says costs that generate or enhance resources of the company that will be used in satisfying performance obligations in the future. Such costs include intangible design or engineering costs that will continue to give rise to benefits in the future. And so just like it tells us in the book on page 1010, companies only capitalize costs that are direct, incremental, and recoverable, assuming that the contract period is more than 1 year. So, again, just some of those things to keep in mind. And then collectability, as we have talked about before, there's always a portion of bad debt, right? For whatever reason, not all accounts receivables are going to be collected. And so we have to think about the collectability of receivables as well. And so the collectability, just like it shows here, refers to the credit risk that a customer will be unable to pay in accordance with the contract. Whether a company will get paid is not a consideration in determining revenue recognition. Remember, even if we think that it's unlikely that we're going to get paid on the contract, we still record the revenue on it, right? So that's not a consideration when determining how much revenue to recognize. What we do end up doing is we do end up, debiting bad debt expense, crediting allowance for doubtful accounts, right? And so that bad debt expense reduces revenue then on the income statement, right? So it's kind of like one of those contra accounts, I guess you could think about. It reduces revenue on the income statement. The amount recognized as revenue is not adjusted for customer credit risk. Again, we hope that all customers pay, but either way, we're going to record the sale as normal and then estimate bad debt at the end of the accounting period. All right, so disclosure, a few of these things that need to be disclosed. It says companies disclose qualitative and quantitative information about the following. So just to kind of remind you what qualitative and what quantitative is. And so, qualitative data is where we're looking at the quality of data. And so, for example, if I say, how satisfied customers are with the product, that's a form of qualitative data. Or if I do a focus group and, I take and I get customers' reactions to the product or to anticipated changes in the product or the price of the product or whatever, and I get their feelings about that, that's qualitative data. The quantitative data, this is like actual numbers, right? Quantitative data. And so some of our quantitative data, again, is like cost per unit, for example, right? That's quantitative data that deals in actual numbers. And so again, qualitative, you could kind of think about like qualitative information like subjective, like feelings, for example, like how customers feel about something, right? Quantitative is objective. These are like actual numbers, right? The actual data. All right, so some of these disclosures: contracts with customers, significant judgments, assets recognized from cost incurred to fulfill a contract. So contracts with customers, these disclosures include, and I'm looking at the bottom of page 1011 right now. It says these disclosures include the disaggregation of revenue, presentation of opening and closing balances in contract assets and contract liabilities, and significant information related to the performance obligation. Significant judgments, these disclosures include judgments and changes in these judgments that affect the determination of the transaction price, the allocation of the transaction price, and the determination of the timing of revenue. And then the assets recognized from cost incurred to fulfill a contract. These disclosures include the closing balances of assets recognized to obtain or fulfill a contract, the amount of amortization recognized, and the method used for amortization. So again, a couple of those things that we would want to disclose. And it talks about these further on page 1012, disaggregation of revenue, reconciliation of contract balances, remaining performance obligation, cost to obtain or fulfill contracts, other qualitative disclosures, right? All right, so, again, I mentioned, and this is what I said is on the top of page 1012, right? Page 1012. I'm not going to read through all of this together. You're welcome to go and look at this, but disaggregation of revenue. This disaggregation information is used to depict how the nature, amount, and timing and uncertainty of revenue and cash flows are affected by economic factors. Reconcile disaggregated revenue to revenue for reportable segments. Reconciliation of contract balances, disclosing opening and closing balances of contract assets and contract liabilities. Remaining performance obligations, again, disclosing the amount of the transaction price allocated to remaining performance obligation, not subject to significant revenue reversal. Cost to obtain or fulfill contracts, disclose the closing balance of capitalized cost to obtain and fulfill a contract and the amount of amortization in the period. And then other qualitative disclosures, again, significant judgments and changes in judgments that affect the amount and timing of revenue from contracts with customers. Disclose how management determines the minimum amount of revenue not subject to the variable consideration constraint. All right. And so, as always, we'll get practice with these transactions. I thought that was our last slide. As always, we'll get practice with these transactions in, I stopped sharing. Hi, guys. We'll get practice with these transactions in class together. So once you have a chance to read the chapter or view this recorded lecture, please let me know if you have any questions, and I will see you guys in class. Bye-bye.